But welcome this evening to the next installment of our Business Owners Forum. And I say next because I lost count. We've had at least 10 of these, and it's one of our deliverables to our clients and to the business community to bring good information to business owners to help them run their companies. And of course, tonight is about protecting liquidity beyond FDIC insurance limits. And Paul, just a minute ago, said to me, so you're going to tell us to spread our deposits around in 20 banks and get all the insurance coverage, because as we know, the limit's 250,000, and 20 times 250, that's, no, I'm just kidding. But that is what this is all about, really, in a connection. So, and I'm going to tell a story before, do a little pivot here and tell a story first. But when Dan and I started the bank, and we didn't start it alone, it was with 700 of our closest friends, our board, a group of business owners in town. We got in a big argument with our CFO before we started, and he's since retired. Wasn't Julie. Julie's over here. Where's Julie? Anyway, so over what then we called CDARS, ICS, Intrafy, and they're going to talk about that we wanted this insurance strategy, that's what I call it, I don't call it a product, well, this insurance strategy for nonprofits specifically. And we got in a big argument about it because he didn't want to do the extra accounting because it required a little more accounting. And he said it doesn't have any applicability. Nobody's going to use it. And there was some truth to that. Because back in those days, it wasn't on everybody's mind, right? FDIC insurance, kind of a boring topic. But it certainly became a relevant topic about a year plus ago, didn't it? So we told him at the time, you're right. It's not going to be the biggest thing out there that we're going to need, but when we need it, we're going to need it. And Dan, to your credit and to the team's credit, we pushed to get that done from the very beginning. And so we've had this insurance strategy since we started the bank because we knew it'd be relevant. It'd be relevant to everyone in the room. And the emphasis tonight has been on nonprofits because nonprofits tend to have policies or board charters that require FDIC insurance, but it's really for anyone that has cash over $250,000, which most operating companies in our market do. So it has a lot of applicability for our clients. So why did we choose this topic? The same reason we choose any topic, because you told us this was important to you. We listened to our clients, and this kept coming up because it was really a push, like I said, in March Madness, March of 23. But we continue to hear a lot of conversation around it. So we said, well, plenty of clients have the insurance strategy, but maybe they don't really understand it to the level that they would like to. And plenty of nonprofit boards and companies with liquidity that don't use this strategy would need to know about it. So that's why we chose to do this. But before we get going, I'm going to do some housekeeping. I think most of you probably found the restrooms. They're out around the corner. Go ahead and excuse yourself if that's relevant. I think you found the refreshments. There are going to be more afterwards. We'll be going here in a minute, and this is going to be an open dialogue, and I'm going to pull a pivot right off the bat and give this microphone to my partner, CEO Dan Yates. Round of applause for Dan. Yay. He told me not to do that. But Dan's going to jump in and spice up the conversation from time to time. I warned my panelists that we're going to do this pivot. But he'll also be asking you questions. And we're going to save our questions for the end, and then it'll be an open dialogue and an open forum. And Max, you told me I was going to forget to push this forward, didn't you? So Max is going to start here. He'll be first up, and Max is with Intrafy. And you guys just started in the FDIC insurance strategy business about last year?
22, give or take years.
Yeah, 22. He'll talk about the history a little bit. I've known Max at least 10 years. I've been working.
5 banks ago?
I haven't been in 5 banks. So I've known Max a long time, but actually it's longer than 10 years. I think I've probably known him the whole 20 years he's been there. Joe Jerkovich, CEO of R&T Deposit Solutions, also is a competitor, but friendly competitor of IntraFi, and he does the same thing, and we want to hear a little bit from him, and he'll talk about what's different between their two companies. And Diane Ellis, she's a special member of this panel, Senior Managing Director for IntraFi. She's a colleague of Max's, but she's also a recovering regulator, she told me. Now, those are her words, Director of Division of Research at the FDIC. And there's probably more to that title than I said, but she's going to bring a little bit of flavor of FDIC, Federal Deposit Insurance Corporation. We're regulated by the state and the feds, and that's our primary federal regulator. And she's going to talk a little bit about how regulation plays into all of this, because it's definitely a relevant piece of this. And Max, I'm going to turn this over to you and let you run with it.
Excellent. Well, first of all, I wanted to start by saying thank you, everybody, for being here. For us, it's a pleasure to be able to see the end customers in our partnership with Endeavor Bank and be able to hopefully have a chance to answer questions and really expand on the knowledge that you all bring back to your organizations. And so for us, that's the value that Endeavor does in this series, and I think we are all about supporting that. So really, disclosures, don't worry about reading them. More than anything, understand one thing. Because we are all regulated, you'll hear it from each of us. These are our opinions. These are not necessarily, the opinions of IntraFi and all of our divisions or management. But here, we're here to help answer questions, give you some history, some context around what's happened and what happened more recently last year on the regulatory side, but also the solutions that banks have brought to the table, like Endeavor, to be able to help deal with kind of those responsibilities and that you're being thrusted upon you now more than ever, and the awareness out there to make sure that you're making decisions that are right for your organizations. And that's really where we want this to go from. We welcome questions, so please feel free to interrupt. We'll also have dedicated time at the end for questions as well from you guys. So we'll circle back on any topics you guys would like to cover. So as Steve mentioned, IntraFi was one of the original brainchilds of really bringing together this type of deposit placement network. Not only where, brokered deposits, where you work with an investment firm and they just farm out the deposits, have been around for 60 plus years. But it's never been a benefit to the local communities that everyone lives in. So whenever you brought that solution to the table, the local banks always lose out because it gets farmed out and none of the benefit goes there. So really the idea that we, starting as IntraFi in 2002 when we opened our doors, was to be able to create a way that banks can leverage each other to provide the conveniences of a network of banks to get expanded FDIC insurance, but do it in a way where those benefits of those deposits can reside right here. And so we kind of invented the term reciprocal deposits, which has been codified into kind of all the normal nomenclature of banks nowadays. And the reciprocal deposit is no different than every dollar you bring in to Endeavor Bank, for example, goes out to get FDIC insured, but they receive $1 back. And so your deposit the benefit of those deposits never leave the local community. And so it allows community decision making to have more flexibility, be able to manage liquidity, and make sure they're bringing those benefits of your deposits locally here. In 2009, we started by launching CDARS, as he mentioned, way back in the day. And that's a CD solution that Endeavor offers. It basically gives you options from 1 month out to 3-year durations to be able to place out funds and get FDIC insured in that same reciprocal idea. In 2009, we launched a checking and a money market deposit account solution we call ICS. And really, that was building on the same kind of interaction, the exchange of accounts, but doing it in a liquid way so that depositors can get access to their money on any given day. And those of you who know, when you put your money in investments, it depends on a secondary market, right? you may have a delay in getting your money back, especially if we see something like 2008, which hopefully never happens again. But when you put your money in cash, especially at banks, that money is guaranteed to be available to you the day that you need it. And so it's always an important cash management option that you have to have at the table. Then in 2018, a big step happened in that codified kind of the term reciprocal deposit placement network, and those really by a law that was passed by Congress in 2008 in May that really formalized, amended the FDIC Insurance Act language to recognize these type of structures and the ways that these happen, really modernizing the idea of that FDIC insurance and how you can gain access to it. And so that was an important step for banks all around the country. Now today, IntraFi, we are the largest deposit placement network in the country, although Orange keeps chasing us, so they're right behind us. But we've grown to be able to, about 3,000 banks around the country, basically a reflection of the country and the whole banking system. We work with banks that just opened their doors, like de novos. When Dan and Steve first opened their doors back in the day, we were here. And we work with some of the largest banks as well, but in different ways. We work with socially focused institutions as well as minority-owned institutions, but really we are a reflection of the broader banking industry, which is and the diversity of that kind of industry that makes the U.S. unique and not just a 4-bank, 5-bank country financial system. And I think that's one of the things that makes us very unique as a country and as a financial structure, and really has made us more resilient, I think, than many others. We've bounced back from the pandemic and from the scares of last year quicker than any other country in the world. And I think that's a reflection of the strong decision-making local institutions like Endeavor Bank make, and the support they have from the local communities, and the diversified nature of we don't just rely on 25% of everything going to one bank. And that's the case in many other countries. One of the things I wanted to highlight also is that the attention on these type of deposits was, in 2008 we had attention, but it was kind of still in its infancy. We had only been 6 years old at the time. But really last year, with Silicon Valley, Signature Bank, and later First Republic kind of having their issues and kind of going into receivership with the FDIC, and I know Diane's going to cover a little more of that, but it really made it so that the responsibility was now on financial officers and business owners and nonprofits and other groups to really understand what's protected, what's not. Because you've got to, you want to make sure you've got money for payroll, you want to make sure you have the cash on hand that you need. And it's not just about yield, it has to be about liquidity. It's whether I can access the money when I need it, and that's the important thing that really came to the forefront. And that really shot up the attention towards these type of deposits, reciprocal deposits, to make sure that they're, liquid, available to nonprofits, businesses of all types, and even individuals for whenever they need it. Especially when you're fortunate enough, like many in San Diego, to have over $250,000 just to operate your business. So, with that, any questions? Or?
Well, I want to jump in. Am I going here? I want to jump in and ask Joe a question for him to incorporate in his conversation. So I'm a nonprofit in the room, and I've been working on this grant for years, and I finally got my $5 million grant, and it's going to fund a program over 3 years. And so that $5 million is going to be with me for the better part of a year and a half, 2 years, a big chunk of it at least, most of it in the first year. And my board is all of a sudden, we've been struggling, a few $100,000 in the bank over time, but now all of a sudden we got $5 million. And my board's saying, wait a minute, we've got a charter a policy in our charter that says this has to be fully insured. What are we going to do? And so I pick up the phone and call the bank. So can you work with that? And then a real story, that's a real story that I heard from someone in the room, but another real story I've heard from the room, a for-profit company, they're a startup, but they're getting their first seed round of capital from a venture capitalist. And he didn't give me the amount, but they tend to not do things in less than 7 figures. So it's going to be multi-7-figure investment. It's going to be around a while. Same fact pattern, for-profit, nonprofit. How do you work with a company like that? They come to me, the banker, and then how does that all play out?
Can you hear me? Yeah. Thank you very much, first of all. It's very nice to be here and to spend time with you all. And to already the conversations I've had before, I've already learned a lot about the various businesses that you're in, and I'm very interested to continue those conversations. With respect to the question, where these programs initiated, we're in situations exactly like you described, where you have your boards, you have investment guidelines, municipalities, where that there's a requirement or an expectation. I myself, we're a private equity owned company. There's expectations that you're going to have a certain level of safety and soundness with your cash. And especially when there's a significant amount, and those two examples that you provided are perfect examples where these products are particularly relevant, where that the funds are fully FDIC insured. And what I'm going to spend my time on is how these programs work. And I think what's evolved, and again, I'll spend a little time on the users. So the users that have historically been, prior to last year, were these organizations that, as I described, had the guidelines, had the boards, and they were driven to use these programs for safety. What has changed is that in the events of last year is that banks have been using this proactively, again, for those investors that are not necessarily required to fully insure their funds, but not to worry. It's just another layer of protection that you can rest assured that the money's safe. The bank is, offering a product that can, again, allow you to sleep at night and not have to worry about your cash balances. And again, I'm pretty much going to piggyback off of Max, what he said.
Lawyers.
There you go. So in terms of how the product, someone mentioned before, a simple way to describe the product is that, or what it's trying to accomplish, you could, go to 20 different banks, 40 different banks. Each bank offers $250,000 of FDIC insurance. But it's not very convenient. You have to set up accounts at each of those institutions. You have to negotiate rate. You have to remember which banks you put your money in, the paperwork, etc. The beauty of these types of programs is that I like to describe it as the Amazon Prime of deposits, where that it's one-stop shopping, where that you're able to, again, with the bank that you know, the people you like, where you have a relationship, you're able to fully insure these balances. And the way they work is that the customer comes into the bank, fills out paperwork through their primary relationship institution, and that's where it all starts. And through that, there's no hassle. You're signing one account opening form. If you have $10 million, you're not opening up 40 to 50 different bank accounts. It's all available through one application that you're completing at the bank. So that if you look at the diagram, the money goes into the bank network. We call our network DDM versus ICS. And quite simply, the money is allocated in increments of less than $250,000. Typically, the bank will take the first $250,000 because that'll be insured. They'll send the rest into the network. And what I don't have described here, what Max was describing, is that the beauty of these programs also is that the bank who brings the customer into the network keeps the funds, so that there's an arrow that goes back from the other banks participating in the bank in the network that are reciprocated back to Endeavor Bank in this example, so that as a customer, you know that even though you're safe and you have FDIC insurance and you may have your balances spread across banks across the country, you can rest assured that that money is coming back to Endeavor. And as Max said before, to use in the local community, so that Endeavor is offering and the banks who participate in the network are offering you a way to sleep well at night in terms of making sure that your money is fully FDIC insured, but the money is coming back to the bank from other institutions in our network.
But the consumer doesn't see that, do they?
Well, the consumer they're not involved in the transmission of money. But when you see, like, I'll go to the next couple slides where you can see exactly where your funds are at all times. But this happens behind the scenes. You know, we have processes in place where and again, we've been doing this, they've been doing it for a little bit longer than we have, but we've been doing it since 2011, where we have efficiencies in place where that we're able to place funds at banks very quickly. At each of these institutions, and sometimes the misconception of these programs is that when you want to put in $10 million, we're behind the scenes opening a bunch of accounts at all these banks. But how it's structured is that there are large deposit accounts at each of these banks that are structured very carefully under the FDIC rules to make sure that there's flow through. And what we do, both of our firms, is that we are record keepers to make sure that for every dollar that's allocated to each of those banks, we know at all times who the beneficial owners are. And that could be seen online, it could be seen from your relationship manager, and so on and so forth. Any questions before I move forward to the next slide? Yes. That's an excellent question. I should have mentioned
Time
that.
out. He's got to repeat it. Sorry.
Yeah, what the question is that does the primary relationship institution set the rate on these deposits? The answer is absolutely yes. You're negotiating once. Regardless of what that rate is, each of the banks in the network will pay that rate. And that's part of the mechanism of how we operate. But you're only negotiating that rate. The rate is set by the sending institution or the primary relationship institution. Does that make sense?
And if I can add, the whole idea is always to keep the control local, right? We don't want someone in Wall Street or someone in North Carolina deciding what are the terms on your deposit, right? This is about making sure that Endeavor Bank or whoever your partner is, they are your relationship. And they make the decision not on a $245,000 chunk, but on the $10 million relationship that you've built over the years with them. And so it keeps it local and it makes it simple and convenient for you because, as Joe mentioned, it's transparent. You see exactly where the money goes. The ownership is always recorded in your name, so it's no one else is ever an owner of your money. This is you as the owner, and it's recorded in a way that the FDIC automatically recognizes. And if any bank should ever fail, which we hope none ever fail in the future, that it immediately files for you to get the money back from the FDIC because we have those records showing you are the owner of those deposits. So it just turns a switch, sends the information, and then you get your money back quickly after from the FDIC. So that the money and even the access to the money is never held up for any extended period of time.
And Thor, Joe's going to show you a statement in a minute where you're going to see your money in all of those banks. Can you go back one more?
Oh, sure.
Where you're going to see all of, and he'll go there in a minute, your money and to answer your question. But from my perspective, it feels like it's all in one bank to you, the client. It feels like one bank, but it's not. So is that a fair?
That's a very fair, and again, you have the same relationship and a good feeling of making sure that your deposits are being placed at the bank and you're not
still see the bank statement at $1 million.
Well, he's got a picture of him.
Exactly.
See the picture.
Yeah.
That was a cue.
Okay.
There you go.
All right. So setup is very easy. You know, there's one, as I mentioned before, one document that you have to sign. They're called the terms and conditions. A couple of very important things that occur here is that you provide the bank the authorization to act on your behalf. That's extremely important. Again, one signature. And what's also important is that you want to make sure all of us have complicated lives in terms of we may have money at other banks. This only works good if you don't double up on the $250,000. So that if you have $250,000 at Bank ABC outside of the program, you want to make sure that you opt out any banks with that you may have balances or balances that you may have in the future. And that's a very easy process.
Opt-out form right there.
Yes. You know, so both of our programs, we have the DDM bank list that you would get at the time, or the ICS bank list at the time, and you would make those decisions. And even if there are banks that aren't on our bank list, if you wanted to opt out those in advance, you can do that as well.
And just to add, you don't need to have $250,000 at a bank. If you have money anywhere outside of the program, the deposit program you're in, whether it's DDM or ICS, make sure that you list it, because we want to make sure that we don't send $249,000 and then you had $10,000 there and now you're uninsured for $9,000. So that's an important point. But I believe there's a couple questions in the back.
Yes, hi. So at the beginning of this meeting, there was a comment about the accounting for, and now I understand why you said that, because I'm an accountant and I'm thinking that maintaining a ledger system like that would be an enormous task. So I'm asking, do you use this kind of thing would lend itself to like the blockchain, for example? Is that part of the technology that you guys are using?
Well, I can answer from our side. We don't use blockchain. We
use accountants.
Yeah, as one of the important things, one of the good reasons for that is, remember, we work within the banking system, right? We're examined for safety and soundness and technology, just like the banks are, because we play an integral role in the financial system, which also means we don't have carte blanche to just implement the latest technology, fad, whatever. It has to be tried and proven over years and years before the regulators are comfortable with kind of blockchain and other technologies that were born of the crypto revolution. We'll see if that fitters or not, or comes back. But the idea is that we use traditional technologies. Us, for example, we use Bank of New York Mellon as our settlement agent, record keeper, and kind of the flow through for any funding. And if anyone knows Bank of New York Mellon, you know that they clear half the transactions for the US government. If you ever need to send money anywhere in the world and you don't know how to get there, just send it to Bank of New York, and then they'll find a way to get it there, because they're kind of play a unique role as kind of one of those conduits for that settlement and record keeping and custodial agent kind of obligation. So we stay traditional, but we're still leveraging technologies to be able to do this quickly, easily, and fast. You know, what 20 years ago when we started took us 4 hours to run, we now do in a microsecond. And so we continue to improve the technology, but still within that framework of what's approved in the banking sector, what's common, what's normal.
Okay, thanks.
And when you were asking that question on accounting, was it from the perspective of the bank or from just your keeping track of the?
Yeah, the ledger system.
Okay.
The ledgers.
Bruce likes have to be
Yeah. Gotcha. Yeah, and I think our background's a little bit different in a sense that, you know, Rich and Tang's been around, R&T, that's what it's short for. Been around for 50 years. We were the third or fourth money market fund, so that we had a full transfer agency, record keeping, platform, which we built when we bought the business from a former competitor of ICS. We built it on top of that record keeping platform. And again, we don't use Bank of New York, but we use Huntington National Bank. Yeah. Same purpose.
Excuse me. I have a question that
Sure.
you mentioned earlier, something about if you have two different banks. I'm so confused. Can you, I'm sure other people confused like me. Something about you have 250,000 one bank and the other 249. I'm so confused what you're saying there.
I think what I was saying before, opt-outs, do you think?
Well, no, I think, so Annette, if I've got your question, or at least the spirit of the question correct, you're wondering what's important about breaking it up in increments under 250,000, right? And as many of you know, and it really went to the forefront last year for many of you, that you're limited under each entity type. So as a nonprofit or as a business, you're limited to $250,000 of FDIC coverage per bank. And if you want more coverage, you need to break it up in increments under 250,000 through multiple different organizations. These networks kind of do that electronically. But if you have money already outside of this network, because when we allocate funds, we do it based on the tax ID knowing where you already have money in the network, which allows you to add money any day, take money out. You could literally come in and drop 100 million one day and take out 20 million the next day, and there would be no interruption to your access because it knows exactly where your money is and it doesn't overlap to take it over 250,000. Your responsibility is to make sure you communicate, the opt-outs as they call it, exclusions that we call it, to make sure that anything that's outside of that network, so if you work with a bank and you're not using ICS or DDM, that you're saying, don't send my money to this bank. Don't send my money to that bank.
It's already there.
Because there's something there and we won't know that. Because these banks, our member banks, don't share all the information. And this goes to another point. In both of our networks, your contact information never leaves Endeavor Bank, right? So your tax ID, your address, the name, your email address, nothing is shared out there. For every single one of the banks that are out there, you're customer 1, 2, 3, 4, 5, for all intents and purposes. But the records are always maintaining that 1, 2, 3, 4, 5 is your entity, so that there's no question who the owner is.
Does that answer your question?
Yeah.
So I would imagine the list we're talking about is being vetted. So there has to be some sort of vetting about what banks are on the list, or it could be any bank.
No, we have a process where that banks that come on the list are generally well capitalized. So they meet a certain level of threshold in terms of before they're allowed to come onto the network.
And one thing I'd like to add, because we do the same thing, but really, we make no guarantees. If you look at the numbers for Silicon Valley Bank, Signature Bank, First Republic, the day before they closed their doors, they were considered one of the top entities in the country in terms of profitability numbers and everything like that. So we make no guarantees that that bank will be there tomorrow. That's why the level of protection doesn't depend on the individual banks. It's the FDIC coverage, that shield that's over your deposit, that really is your backstop. That's the credit exposure. It's that FDIC protection that is absolute. It's backed by the full faith and credit of the U.S. government guarantee. The FDIC is a self-funded, banks pay into it. It's a self-funded insurance, but it's backstopped by the U.S. Treasury, which gives it that guarantee. And so it always is there. And since its inception, and Diane will go into it, so I hope I'm not stealing your thunder. Since its inception, not a single.
Oh, you're not going to. Oh, you can't share that line.
I see a question.
My line.
I'll leave it for Diane, but she'll give you the history on what
I
that
see a
means.
question.
Hey, Max, I want to take off on something you just said. What did you say about the day before those banks failed?
Yeah, so if you look at, what is it, the Moody's rating or the S&P rating for Silicon Valley Bank, the day before they were above investment grade.
So let me take something. The theory behind the way we set up FDIC insurance is we have asked all of you to become experts to evaluate the safety and soundness of a bank. Raise your hand if you can read a bank financial statement to the degree of determining how safe they are, so you will know they won't fail the next day. I want to see your hands all go up.
Yeah.
Thor,
We're going to give you a quiz, Thor.
You get an invitation to be on my bank board.
You're going to get a quiz, Thor.
So here's my question. First Republic, great bank. Many of us had a great deal of respect for them. They had this product. The Wall Street Journal ran an article after they failed, and they said, why don't more banks make this product known to their clients? Can you talk about what happened at that bank in particular or others as to why more of their clients weren't taking advantage of this product? And here's why I asked the question. Had more of their clients used this product, there would have been no reason to leave the bank. The bank failed because clients lost confidence and they moved money out
Right.
very quickly, millions
Old-fashioned
per
bank
second. Millions per second. Had they been in this product, those clients of First Republic would have had no reason to the flight to safety because they would have been fully insured. So what was the issue there?
Yeah, I'd say with respect to one of the bank CEOs that I spoke to that chose to use the product was that he was a pilot, and he was and as a pilot, he's like, if I'm in a situation where there's danger, I got to look at all the tools that are available to me to help land the plane. So he's one of those banks where he saw the value in the product in terms of just calming the nerves, in terms of creating stability. And I think when you looked at another bank that was in a few months later, NYCB, Flagstar, what was the one thing that, there are a couple things. I think they're fundamentally sound, but one of the interesting things that they put out in the paper was their reciprocal capacity, meaning how much of this product that they could offer to their customers, and that they were actively pushing that. And a lot of people attribute that to them getting through the crisis that they had, in terms of what we went through in the latter part of earlier this year. But I think for First Republic, one of the things I want to get back to the other point was that I also get asked the question when you ask me, like, how do I know when to bring a bank into the network, or what is our process? People ask me, well, would you have brought Silicon Valley into the network in February? Absolutely. I mean, it's a matter of First Republic, absolutely. And I think that I echo your point about, there's no guarantees. And we also want to create stability.
I'm going to wager they were in your network.
They were in ours, and I will tell you, they weren't selling it actively to their clients because Silicon Valley, which is even more than First Republic, Silicon Valley had 94% of their deposits uninsured. So they were obviously not offering their clients expanded FDIC insurance. So they were doing a disservice to their clients by doing that. And what do we see the moment?
Was that to do because of keeping yield for themselves?
I think, there's obviously flaws in that led to their failure. It wasn't just one thing. The lack of confidence had to do with the domino different effects: management, decision making, recognizing losses at the same time that they're trying to raise capital from their investors. All those things led to kind of that lack of confidence, and then a tweet that literally raised the awareness to the general customer base to say, hey, look, your money's not safe here, pull it out. And that's what caused a big run.
But it was a run on the bank that took them down. There were a lot of things that led to the lack of confidence, but to Dan's point, it was a run on the bank that took them down. And if they had this FDIC insurance on all of their deposits, why would they have lost confidence in how to run on the bank? Diane, you haven't been jumping in here because we've been working our way down the line here. Is there any, particularly Dan's question, why didn't they have, and I think you may have been the one that posed that question when we were practicing. We don't have really good answers for that. And so if you've got an answer to Dan's question, why didn't they have your product or any of the things that have been asked so far, jump in.
I think they were thinking like your CFO, I think until the last minute they were thinking, you don't need it. Why incur the cost? Why us incur the cost? Why the customer incur the cost? What's the risk? There's no risk here. We're a well-run, well-managed bank. But things changed incredibly quickly. So that's, yeah, I think they just didn't, they did not appreciate, their customers didn't appreciate the risk. I want to finish up, since I cut Max off on the line. One of the mantras at the FDIC is no one has ever lost a penny of insured deposits, ever, in the history of the FDIC. It's a full faith and credit guarantee of the United States government. You don't have to do due diligence or credit analysis on a bank when you've got less than 250 in that bank. You can be rest assured that you're going to get your money back. I'll wait till I think I'd like to pick up on this a little bit when I get to one of my slides. I'll show you sort of a history, a little data that I also think might explain why people are lulled into thinking they don't need to manage this risk.
An issue that's bouncing around, and we probably should bring it to a fine point. It really didn't matter if Silicon Valley or First Republic were in either of your networks, because what happens when a bank fails and they're in your network? I think that's important to explain.
I can speak because Silicon Valley was a member and First Republic was a member, and some of the other banks that made some headlines that were considered potentially the next one to go. New York Community Bank, Flagstar, which Joe mentioned. Those hit the press some concerns. And what did they do? Their game plan is to immediately let people know why they're not a risk, why they should keep their money there. Because I'll tell you right now, most banks in the country, and the vast majority, and Diane will go into some of this to give you some context, but they're well-run, regulated institutions making sound decisions, especially community banks, in their local communities. They didn't see a huge run on their deposits. Why? Because a lot of them had the foresight to be able to say, look, those customers that I know need the additional protection, they brought the tools to the table, whether it was DDM or ICS or CEDARS, to the table to be able to make sure that they had that solution so that those folks weren't running to the big banks on Wall Street. That solution, so a lot of the bigger banks, Silicon Valley especially, they leaned on their reputation. They leaned on the fact that they were big. They leaned on the fact of saying, oh, come on, I'm Silicon Valley Bank. Why do you doubt that I'm going to be here tomorrow? And they weren't addressing the underlying concerns that what type of volatility does that bring to your balance sheet when you have a single customer with $2 billion uninsured? And when you have that type of concentration in certain customer segments and aren't a well-balanced institution like Endeavor and many other community banks around the country, that are balanced and not concentrated just on one niche market. And those were the pressure points, I think, that caused that. And the community banks that had the tools available, they didn't suffer. They didn't go away.
We got a question over here.
So, quick question: has uninsured deposits, percentage, dollar amount, has that always been a part of assessing a bank's credit strength? The viability of the bank, and is it more so now? Has it always been there?
Let's let Diane have that.
Yeah, sure. I'd be happy to take that. When an examiner goes into a bank, I think they always, typically look at the level of uninsured deposits. Typically, when I read 94%, I was pretty surprised. I think the average is more like, 60 or 40, 50, 60, somewhere in that neighborhood. 94 was really high. I thought, wow, that looks like a bank of, the early 1930s, for all practical purposes, with no insurance. So that was extraordinary high. And everyone, it's sort of like, you can't really appreciate the risk until it manifests sometimes. It's like a bunch of tinder, kindling or whatever being built up. And, you're looking at a pile of, flammable stuff, but it's not till someone lights that match that you're like, oh my gosh, we've got a big problem here. But yes, I think examiners always looked at the stability of a deposit base, and the level of uninsured would factor into that. But I think they have I'd say it's fair they have a much more heightened appreciation of the risk now. And also another thing that's different is the speed at which money's moving now. That's another thing.
Not have these reciprocal deposit arrangements now that are there.
Is it what?
Is it not
Well, I think and just to chime in, just last year, the regulators came out and said one of they usually have like 7 pillars that they go into an examination to kind of, when they look at a bank and say, these are the things that we really focus on. They added uninsured deposits last year as a real pillar of the evaluation that they're making on these banks. And I think hindsight's always 20/20. It's always easy to say, oh, the housing bubble, in 2006 was unsustainable. But those things, to enact change takes time, and to realize how to measure appropriately the risks. And in a dynamic environment where you have technologies that can move money, part of it because of the pandemic, quickly, seamlessly, in large quantities without really a lot of intermediaries, that I think exacerbated kind of the challenges that Silicon Valley, First Republic, and other have on a comment that hits the social media and suddenly cause a flare-up.
We're talking earlier that the failure of Washington Mutual, which was 2008 or 8, I think, it experienced a run of the similar proportion to what Silicon Valley, but over a week or two. What happened to Silicon Valley in a fraction of a day. Banks, as they were getting into trouble, used to have more time to go borrow from a Federal Home Loan Bank or raise rates and gather more deposits. They just didn't have any time this time.
Mark, from my perspective, the answer is no. The regulators weren't focused on it. Neither were clients, neither were banks in terms of the uninsured level. Dan, you could speak to this. I mean, when we were getting visited by regulators, was that really a focus before March of last year?
No, for 30 years of my career, I've always led banks that had business clients, which means by definition, they almost all have over 250. So right before March of last year, if you looked at Endeavor's balance sheet, we probably had 70% or more of our deposits uninsured. But when we saw the speed at which those banks failed, we did a 100% reach out, and our balance sheet transformed overnight. And if you saw the slide that Max put up earlier, you might go back, the use of this product nationwide spiked to an all-time high. When you look at this bar on the right, we're part of that blue bar. That's all banks in the country. And we recognize that not just the FDIC, but the media and other clients are starting to look at banks and say, how much uninsured deposits do you have? It not only was the right thing to do for clients, it was the right thing to do for the safety of the bank. And our deposits, the majority of our clients opted in to having full FDIC insurance. Why wouldn't you? There's no reason not to. The alternative to that, and we saw this happen after First Republic fell, is a lot of clients moved it to the too big to fail banks. That would be Chase, $4 trillion in assets, and that is a solution. One of the questions I have for the panel: the first time in the history that I've been tracking deposits in our country, we had a decline in deposits in the banking system leave the banking system. That means all banks combined, to the tune of over $1 trillion. We think a lot of those funds went into U.S. Treasuries. So another solution to what you're offering is go to treasurydirect.com. Why would somebody choose to use a reciprocal deposit solution versus just buying U.S. Treasuries? Could you speak to that? Pros and cons.
Yeah, I would say that you lose something. In terms of the relationship with the bank, the access to your funds, the mark-to-market, the market forces on the treasuries, even the risks of money market funds, which is another. It's either money market funds or treasuries. Money market funds are not FDIC insured. In terms of the relationship with the bank, keeping the funds in the community, they're not coming back to the bank. That's a one-way out of the bank. And so I think those are certainly disadvantages. But we certainly saw, I know banks saw, but we certainly saw in our broker-dealer programs as well, that there was a tremendous outflow to rate chasers in terms of going to treasuries and money market funds. But what I caution is that you are losing something. You're losing that relationship with the bank. You're losing that access, easy access to your funds. And that's something, of value.
Yeah, my observation was that in addition to the funds running out of banks, it also made the depositor base more rate sensitive, more rate aware, and they were flowing. I think for 6 consecutive quarters, the banking industry lost deposits.
I think there's one more thing that is worth noting, particularly for the nonprofits in the room. You're all serving a mission to our community. Maybe different missions, but important missions. Try to imagine what happens if you think of a balloon. When you let air out of a balloon, it shrinks. When you take deposits out of the banking system, you're taking the gas, the fuel away from banks to make loans to our communities nationwide. So when you take $1 trillion out of the banking system, that's $1 trillion less in loans that can be made. That slows down the economy. So what do banks do? They start to ration loans. How does that show up? First, it shows up at higher rates. Then it shows up, we're not going to make the loan unless you bring your deposits. It starts to become a negotiation. You never saw that in the last few years, but now, more frequently, when you go into a bank and you apply for a loan, they say, well, where are your deposits? If they're at another institution, they say, well, we're not going to make the loan. That's because we took the air out of the balloon. So it actually was detrimental to the economies across the country for the local institutions that nonprofits are serving. So yes, you could certainly go into U.S. Treasuries, but the last time I checked, you don't apply to the U.S. Treasury for a loan. They're not real happy about that.
Wendy's trying to tell me something. What?
Oh, I was just going to, can you hear me? I was just going to ask about the annual audit, which is our favorite word, audit, and how that would work with like bank confirmations. Does the confirmation just go to the one institution, or does it have to go like a confirmation to all the different institutions?
It basically goes to the primary relationship institution.
And that suffices for them, even though the money actually doesn't exist there at that.
Yes, but there are records that, and again, one of this, and I know I have to finish my section here, we're going to go on to Diane, but one of the sections here is that in terms of the access to know where the balances are, it's all, of course, we maintain those balances, but the bank always knows where those funds are. And more importantly, the depositor can log online and always see exactly where their funds are.
So Dan, you said, why wouldn't you use this network deposit? And you may have answered my question, but I want to be clear and make sure my question is answered. My question is, I assume the two organizations up there don't work for free, and that there is some cost in using this network. So if I came to Endeavor Bank and said, here, I want a 5-year CD at your best rate, I'm willing to fly without FDIC insurance, would you give me the same rate or a different rate if I wanted the network protection?
So anybody that works for me knows my 2 favorite words. Who wants to say it?
It depends.
Say it out loud.
It depends.
Yeah, see, they know me well. I need more information, Chris. Do you have a checking account with us? Do you have other loans with us? It's a relationship business. You look at the big picture. And my answer could be very different from one client to the next. It's not a one-size-fits-all. So you look at the total profitability of the relationship, all the reasons we're doing business together, the years we're doing business together, and there are times when we eat that cost, we absorb it. There are other times we might offer you a slightly lower rate to absorb the cost of the network, and there are other times when we pass it on. And so it really varies looking at all the components of that relationship.
Okay,
That
thanks.
should be true with all banks, I would just say. I mean, that's just good business.
Okay,
Yep.
thank you.
And I think that cost is what tripped up how to handle that. Some of the other banks and why they just left it off the table, and it wasn't a big deal until it was a big deal, and they really didn't have a strategy to deal with it. One of the banks, we interviewed a lot of their people after they were, and we heard that they lost their incentive to if they put it in this product.
Let me add one more thing. We had almost 16 years of near zero interest rates. So for about a decade plus, the users of this product were not really rate focused. They were focused on the insurance, the safety of their money. It's only been the last couple of years when rates, the genie's out of the bottle, rates became an issue, they became real money. And so now banks have to figure out how to offer this product and deal with that cost. And that will vary from institution to institution. Without getting too technical, you heard the question or the response. what if you want to, say, place $10 million at one institution and negotiate a rate? How do you not negotiate with all the other 9 banks, all the other banks in the network? There's a rate bridge, and we basically absorb that cost. If other banks are willing to make a CD at a higher or lower rate, we adjust for that. But your negotiations with one institution. Yeah.
I don't even know what I'm doing in this room, okay? Because I'm a simpleton. But if I give $1 million to Endeavor Bank, and then they keep 250,000 liquid, and they give 750,000 to you guys, and I negotiate a 5% return on that $1 million or whatever, and then you guys figure it out however you figure it out. You put it into 3 other or 4 other institutions, and guarantee that rate comes back too, so that we continue to get our 5% and everything's insured. Is that how it works?
Exactly.
For a simpleton, I think we're ready. I think we're done. I think we're done.
Oh, do you want to sit up here?
Are we ready to?
Yeah, I think we're ready to move. I think we talked about the benefits for depositors, access to FDIC insurance, the convenience of one banking relationship, and again, opting out of participating banks. So I think with that,
It's my turn. Oh, no, I'm going to take that one thing. Yeah. Okay, so now for something a little different. While I am an employee of IntraFi, I've been employed for only about 20 months or so. Prior to that, I spent a very long career with the FDIC. I've spent a lifetime thinking about deposit insurance and related fascinating issues. So I'm going to go through this couple. I've only got 3 slides here. I'll go through this first one pretty quickly. But when I think about I'm here to talk about from this issue from the perspective of the FDIC. And first of all, I just wanted to raise the issue of depositor awareness. Depositor awareness is a very important priority for the FDIC. They have numerous resources here, which are sort of illustrated. They have a campaign going on right now, Know Your Risk, with a cute little piggy bank. They've got videos and brochures. They've got a 1-800 number. They've even got a calculator. They call it ED, Electronic Deposit Insurance Estimator, where you can go in and put in your accounts and it'll tell you what's insured and not insured. They're concerned about a couple things. One is they want depositors to know what's insured and what's not. For example, some banks sell non-deposit products, mutual funds, whatever. They want that to be very clear in advertising and signage and so forth. Like a mutual fund is not insured, a deposit is. Right now, one of the hot issues is the fintechs, who are sort of fronts for banks, making it clear what's insured there and what's not. And then, of course, they also want the customers to know the amount that is insured. So because it's a bad situation, when a bank fails and a depositor was just unaware of what their situation was. And this is awareness has to be such an important issue because deposit insurance really isn't that straightforward sometimes, unfortunately. We've been talking about the standard deposit insurance amount, which is $250 per depositor, per bank, but by ownership category, and that's what makes it complex. It's not just by account, and some people think that's the case. I open up a second account, I'm going to get a second $250. No, it depends on what your ownership capacity is, and at the FDIC they call it rights and capacities. Now, some of this that you see here, I've listed out here the different types of accounts where a different $250 applies. The FDIC, if a bank fails, comes in and they aggregate an individual's deposits by category and apply the $250 limit to each category. Some of this, what you're looking at, is legislatively prescribed. Some of this is regulatory prescribed. So, for example, the $250 limit, that takes Congress to change. The FDIC can't change that. Some of these ownership categories are also congressionally mandated, like government account and corporate account, but then some of it is regulatory and has evolved over time. So for example, the last change the FDIC made to insurance categories was an attempt to simplify trust accounts. They had different rules for revocable and irrevocable, and they said, forget it, we're going to make that the same and try to simplify. So again, it is kind of complex if you have a lot of different account types. And this, of course, is only practical, when a bank fails. So now this is where I want to spend most of my time, just showing you this chart with some data on the number of bank failures from 2001 to 24. And there were a total of 567 failures. Now, we started this time period with 9,904 banks. So, that's not a huge percentage. It's a little less than 6%. We have about 4,500 banks now. There's been a long-term trend for consolidation. But basically, the bottom line is not a lot of banks fail. Most banks are healthy and strong and survive, tough economic downturns. So failures are pretty rare. The second thing to keep in mind is that when a bank fails, actually it's quite rare that a depositor, even an uninsured depositor, loses money. And that is because the FDIC also has resolution authority. So in addition to deposit insurance authority, they resolve a failed bank. And they have many ways in which they can do that, but they're required by law to pursue the least cost transaction. They have to, usually when you've got some time, when the FDIC's got some time, a failure's coming, they size it up, they market the bank, they look for other banks to take it over. And that's actually what happens in about 90% of the time, is that there's an acquirer that comes in, and they call it a purchase and assumption, and the acquirer takes some or all of the assets, depending on what they want, and then they take all of the deposits. So while I think the point is, while failures are actually kind of rare, even when failures occur, it's kind of rare that it's not an all deposit purchase and assumption. 509 of these failures that you see were all deposit purchase and assumption. So all depositors were protected, and other banks are willing to do that because there's value in that franchise. Even though that's a failed bank and maybe its assets are a little suspect, there's usually franchise value, and they want that deposit base, and they're willing to bid a premium for it. They're willing to pay for it, which is why, so rather than destroy the franchise and chop it all up, basically, there's this technique allows the FDIC to keep that franchise intact and actually minimize the cost by selling it to someone willing to buy it for even a premium.
Diane, this blue line there
Yeah.
it represents what happened in 23.
Yeah.
Did any of those depositors?
No, they did not. Now, in that particular case, no depositors lost. Now, two of those failures, and I'll tell you why. So, two of those failures were Silicon Valley and Signature. Yeah, Signature. And they occurred on a single weekend. Now, initially, this is where it was a really thrilling weekend. I'm sure I was kind of glad I wasn't at the FDIC anymore that weekend.
Our board was meeting continuously that
It was a really thrilling
weekend.
Because SVB was such a surprise. I mean, the FDIC got no warning whatsoever. I mean, there was no opportunity to market that bank, to find acquirers, so on and so forth. And that least cost test originally, when you take a pencil to it and you say, wow, there's all these uninsured depositors, that actually absorbs loss. The least cost test is just to make those depositors absorb the loss of this bank. So it looked like that was going to be a payout. I mean, it was going to be, and they actually, that's what they announced. They announced on that Friday, technically they were setting up a different bank just to take the insured deposits. And what would happen to the uninsured deposits is that they would put them in receivership along with the assets. And then as the FDIC sells those assets, they would pay dividends to the uninsured depositors first, then the unsecured creditors, subordinated debt stockholders, but you'd have to sit around and wait for your money. Well, then you have the follow-on. Now Signature's got a problem, and I think there were concerns about other banks. I think as the weekend, as the dust started to settle, or maybe it was getting kicked up more. I don't know what the right analogy is, but they realized that this was a panic. That depositors were panicked, and if they went through and these uninsured depositors at Silicon lost all their money, that the panic might spread. So what they did, and this is kind of extraordinary, but they declared a systemic risk exception, and there are authorities to do that. It's when the Fed and the head of the board of the Fed, the board of the FDIC, and the Secretary of Treasury recommend to the President of the United States that a systemic risk be invoked. And that's what happened, which allowed the FDIC then to put the whole thing in receivership to protect
Dan,
all those depositors.
You want to make a comment?
Just kind of related to everything we're hearing today, but how many of you are directors of a nonprofit board? So you probably know the term duty of loyalty and duty of care. So imagine it's about 4 or 5 years ago, and I go on the board of a foundation, a large one. Some of you know the foundation I serve on, and there's a little thing called $1 billion plus in assets, and I'm the audit chair. And I go to the notes of the audit, and how many CPAs do we have in the room? What's the footnote you put in the audit when there's uninsured deposits? How does it read?
Unfortunately, Dan, the tax accountants aren't here in the room.
All those tax guys. Well, there's a little footnote that put me on notice that said we have X millions of dollars that are uninsured. Now, I could have been satisfied with that because the money was spread over many banks, very large banks, probably too big to fail, but I still have a duty of loyalty and duty of care. And I think when you become aware of these products as a director, you don't need to change banks, but you can go to your current bank and say, can I take that uninsured deposit and remove that footnote from my financial statements? The answer should be yes, because most banks have these products. We saw 3,000 in ICS out of 4,000 plus banks. That means the chances of you currently, if you're not a client of Endeavor, I don't know where you're banking, but the chances of your bank not having this product should be very small. The chances of your bank not informing you of this product, that might be another conversation. But as a director, well, it could be the cost, it could be
The CFO.
I interviewed some former bankers of a bank no longer with us, and I asked, why didn't you offer this to your clients? And they said, well, my personal performance bonus was tied to keeping it in a checking account. Ouch. He or she's not working with us. Say no more. That's called integrity. But the point of this is, banks do fail. Yes, there's a good chance, historically speaking, that another bank will pick up those uninsured deposits, but why take the risk if you have the Attorney General of California overlooking nonprofits and you're a board member?
Yep.
Just saying.
The other point I think this chart illustrates, and we were sort of getting at it earlier, is sort of the complacency that sets in. You know, bank failures tend to occur in waves or bunches. You know, you go through long periods of time where there are no failures. This period here, like the end of 2004 up to 2007, it was 958 days, you know, between bank failures, almost 3 years. And even here, it was, let me look at my notes, 868 days between the last failure in 2020 and Silicon Valley. So, you know, I think people, it's just not top of mind. You know, deposit insurance, you know, is not top of mind. You're not reading about failing banks in the press, and it makes awareness hard, and the risk just seems more remote. But then they come, you know, and they come big, and they come in waves, and now we've learned it happens fast. So, and then all of a sudden it's top of mind, you know, and everyone's like trying to manage the risk then. Hopefully it's not too late.
I would also add that it's not just small banks that are at risk, even those that Dan used the term too big to fail. It's a misnomer. It doesn't exist. Now, will the government step in and enact some emergency policies if it's something that they deem would have a really big impact on the economy? More likely than not, yes, but That doesn't mean that someone can't let, like Lehman Brothers, who was considered a really big organization, and they let it go. Why? Because part of it is also you have to understand the risk you're taking, and just as part of being Americans, you have to understand that if you take risks, there's a cost, and that's fair for everyone because you taking the risk, you got some better returns. So understand what that risk is, and if you work for an organization that doesn't have a high risk tolerance, then that's fair too. Just understand what the risk is. It's the fear of not knowing what the risk is what the FDIC doesn't want, what the regulators want, that really cause headaches.
Question.
Yes, hi. I understand there are differences between FDIC insurance and then, for example, if you have cash in a brokerage account. Could you delineate what those differences are?
So FDIC insurance applies just to banks, just to bank deposits, and it's to protect that depositor in the event of the bank's failure. Completely separate from mutual or investment, which is I think more like
SIPC?
yeah,
Civic?
which is more like fraud. Is
Yeah,
that sort more
so
like fraud?
SIPC, which is on investment products, that what some folks try to sell you on is that that's federally insured as well, but that's against fraud, not against loss of funds. Right. And so only if your broker defrauded you, it was a Ponzi scheme or something, is the SIPC ever stepping in the middle of it, or if so it's not the same as FDIC insurance, and so it's important to note, and just to build on that, some of the brokers out there, they offer insured cash accounts, but generally they tend to be pretty small in the amount that they insure.
And they also do sweeps, right? So they'll sweep it into a mutual fund or a money market.
If it's in a mutual fund, and I think, Bruce, you raised an interesting point that I want to clarify. Too often people confuse a money market account and a mutual fund, which is a money market mutual fund. They name it very similarly. I don't know why. Only the deposit account is insured. A money market mutual fund that is an investment product is not insured in any way. You share the risk of loss of the pool. So everyone buys, a bunch of securities, treasuries, assets, all those, and then you share in the potential gains and risks, losses there. So it's diversified it in a way that you wouldn't be able to do on your own. So it's relatively safe. But as we saw during the financial crisis, there's no guarantee that that money will be there, because if there is no one buying and selling securities, what's the value of that treasury if no one's buying it? It drops like a stone. And so until you find a buyer on the other end, you don't get your cash out. And there's new rules that were in place. Just even last year, they were tweaking those kind of rules on money market mutual funds to kind of deal with the transparency of the risk. And so,
Thanks.
So we're just having too much fun here, so it's continuing on longer than I thought. Wendy is waving at me. We'll allow one more. Are you finished?
I'm pretty done. Yeah,
Okay.
I think I got everything. I think I eventually stuffed it all in. I think we're good. We're good.
All right.
Let's take one more question.
Do you have a comment? One more question from the House. Oh, look at that. Oh, okay, we'll have two.
Oh, okay.
Hello?
Hi.
Okay, so I think everybody knows about the switch to digital currency, which is on the horizon. How is this going to incorporate, like all these things that are in place now, are those going to transfer over to that, or is it a completely different game? Because there's a lot of noise. I don't think there's enough people with a lot of knowledge.
I think we're in our infancy with the understanding of how digital assets are going to be treated. Because there's, I think the big surprise, the regulators were moving in the direction of kind of creating a kind of what's called stable coin in terms of a government-sponsored kind of digital asset. And that was backed by a hard currency like the dollar or the yen and things like that. And some countries have moved forward further along than the US has. The US really hit a pause on that because what they noticed with, and even before Silicon Valley, this was in 2001.
Max, the short answer is no.
Yeah. There you go.
Keep it simple.
I agree.
Question over here.
Yeah, I agree. Nope.
Thank you. I want to go back to Dan's question because I may have missed it. So, your question earlier, Dan, was, well, Silicon Valley Bank was in the network, First Republic in the network. So, what happens to the network when they fail?
You mean what? In most cases, when a bank fails, again, I said 90% of the time, just a new bank takes over. So it's a matter of just switching customers from one bank, to another. So it's essentially a name change. Is that kind of what you're asking? Are you asking what the health of the network?
Or what happens when the unusual event where there's actually a failure, where there's it actually liquidates, is that falls upon both networks operate the same way, where it's our responsibility then to file a claim on behalf of the impacted depositors.
And those procedures are very well worn, well tried and well worn. Both the FDIC, and Interfine RT are,
Okay,
partners in that.
Let's leave the answer there. Go ahead.
Yes, hi. Thank you so much. So on that same line of questioning, how many networks are there right now, and who actually regulates the network?
So I don't know if I have the total count. I know that there's probably less than a handful of any meaningful size that can offer expanded FDIC insurance at a sizable level. You're talking to 1 and 2 on the list right here. And the regulations really fall on, so when you get to a certain size, you're deemed kind of important enough for then you fall under the regulatory framework that the banks have. And so we are looked at primarily for the technology, safety and soundness of the handling of the information, data, and exchange. And so we're regulated by the FFIEC, which is a joint council of the Fed, FDIC, and the OCC, which are the 3 main banking
So, Joe, you're regulated by the same regulators that we are.
Yes, and I think from the perspective of, and this is like speaking to my own investors about, what the value to these franchises are, it's really about the network in terms of the depth. It's not only just a matter of having relationships with hundreds of banks. Like we have 400 banks in our network, so we could offer, $50 million. But it's also a matter of how much can we do with each of those banks. If you have a very thin amount where you could offer 50 million but only once, and you could only put 50 million with one bank, it's really and again, this is coming from the perspective of the challenger firm, where that, when we bought the business in 2011, our DDM product had $45 million in it. Today we have 62 billion. So it was to catch up with these guys, which we're still trying to catch up to. I mean, it's been a struggle of building that network. But once you build the network, it's kind of a moat, which really protects, it makes it hard for number 3.
Okay, pull them aside out in the cocktail lounge and ask them more questions. We're gonna have to wrap it up. Wendy, thank you very much. Kim, thank you very much. Amber, thank you very much. And Jessica, thank you very much. They did the heavy lifting to put this on, and to our hosts here at the venue, thank you very much, guys. You did a great job, and the audio worked perfect. Last time it was a little sketchy. But keep your eyes and ears open for the next installment of one of our Business Owners Forums. We try to do at least 3 of these a year, maybe 4. There'll be another one in the fall, and we thank you very much for coming. We hope we gave you some things to leave with.